Hi, I'm Josh Campbell, CEO of Worth Media Group, here at the Milken Global Conference with David Steinbach. David, thanks for joining me today.
Yeah, thanks for having me.
So for those unfamiliar with Hines, give our audience sort of a sense of what the company does and really the scale.
Sure, we are a privately held real estate investment manager. We manage about 100 billion of assets really around the world. We're in 31 countries, and we both help investors in how they want to deploy real estate into real estate itself. So we focus on real estate and the built environment. We both sponsor developments as well as acquisitions all around the world.
You mentioned the difference between buy and build. A lot of people think even corporate strategies, buy, build, partner. In real estate, slightly different. But talk about the difference and currently the market we're in and really the strategies that you're looking at.
The private markets and public markets are in two very different places. They don't run necessarily lockstep. And certainly the public markets have had a really good run the last few years and are seeing increased volatility right now just because of what's going on in the broader macro environment. The private markets, meanwhile, are in a very different space. And really it began in 2022 when interest rates started increasing, right? And we saw 500 basis points of monetary policy expansion really around the world. That was one of the single largest rate hike series that we've seen in a very, very long time. And it really caused real estate to reprice all around the world. And so really leading into last year, we were really bottoming in terms of where we were. And deal activity was way off of any measure of where we should be. And so that, for us, even leading into what's happened in the public markets the last couple of months, we were just having a very different space of seeing a lot of fantastic repriced opportunities really all around the world. And so that's kind of the environment that we're in right now, where it's a great time to be buying.
You guys are both in commercial as well as residential. Talk a little about sort of what's happening in the market right now. Where are the opportunities? Post-pandemic with remote work. What have you seen with commercial, mixed use as well as residential? Where are things moving?
Right. So investors, when they are thinking about how they invest in real estate, they first need to. There's the product, and then there's also the strategy, right? So on the strategy, without question, there's moments where in the market cycle you want to be a buyer. And there's other moments you want to be a builder, you want to be developing. And so those kind of shift back and forth, it depends on pricing. Right now, without question, we're in a buy moment. 66% of the markets we cover around the world have a strong buy signal, and we've not seen this signal this strong since 2016. And so we are very focused on buying. But what that also means that no one's really developing right now. And so all new starts, new construction, new development has really been pushed off. And that's going to be a problem. And I think the market isn't fully appreciating that right now in terms of what kind of problem that's going to be. Because we are seeing that the best products are seeing rent growth, they're seeing great occupancy. And the problem is those spaces are getting leased up and we're going to run out of them. And so that will only drive further rent growth. And so that's kind of some of the opportunity set. More broadly, though, getting into the product types, and we're active in all product types. So when we think about real estate, we want our teams really to be agnostic to product type and just think about highest and best use. Think about how we can create the most value from this piece of dirt, this land, and what we can do. And so when we're looking at the spectrum of what we can do, certainly living, and living is multifamily, it's student housing, it's single family rent, it's even doing land for home builders. That has been one of our strongest convictions really around the world. It's for a lot of different reasons. But the US is about 2.5 million houses short of what it needs to be. And the rest of the Western world is another 6 million houses short. So there's a significant undersupply that needs to be developed into. Other sectors, certainly retail is a sector that has been battered for 15 years. And a lot of retail has already been destroyed. The winners and losers have mostly sorted. And the omni-channel now has begun to be worked out. So look at Amazon, Whole Foods in terms of how that's working. And so we see an opportunity there. Logistics is a bit more bespoke in terms of how we are approaching it. Certainly what's happening now with tariffs is going to create more friction cost for global trade. But what we think is that while there are going to be some losers in that, there's going to be new winners. There's going to be new quarters of demand that get created. And so how we think about that is another important topic. last but not least is office, and it's something that I get asked a lot about, and it's really important to remember that the office sector is immense in terms of where you can go. And without question, the best buildings that we sponsor and managed are leasing, and in some cases the highest rents in the city. And so that dynamic is very disconnected from capital markets, where capital markets is saying, office is dead. We actually think that's an opportunity. And so right now we're most focused on credit for office because there's a real dearth of lending, given the regional banks are on the sidelines, a lot of the national banks are on the sidelines. And I think as the year goes on, we'll be drafting into equity and dollar costing in equity in office, but we're being selective in what we do.
Yeah, I mean, I think in New York, we're seeing Google, Facebook just acquiring more and more office space. So I think as we come back to work, as many people in New York, especially in finance, are back in 5 days a week, we'll hopefully see that occupancy continue to rise.
Without question. We're seeing that around the world, actually, beyond just the United States.
So talk a little about sort of the different dynamics between what you're seeing in the U.S. and rest of world. Any learnings, any indicators that are happening globally that we should be thinking about in the U.S.? Where is the leading indicators? Are they the U.S. or are they other markets?
Well, yeah, it is interesting. You see kind of different geographies play out in different ways through cycles and time, right? So in 2008, it really was Europe that was kicking the can in terms of repricing. Within Europe, it was really Northern Europe did pretty well, and Southern Europe not so much. As we all know the stories of Spain, Italy, and what was going on there. And in 2008, it was the U.S. that was repriced quickly and moved fast. This time around, some things are reversed. So actually, this time around, Europe repriced first. U.S. was a little bit slower, but again, we're beyond that at this point. This is like 3 years. This is the last 3 years we've seen U.S. be slower to reprice. And in a place like Europe, actually Northern Europe has been hit pretty hard, and Southern Europe has actually been a lot more resilient. We're seeing some interesting opportunities there. So those kind of indicators are interesting, but I think it's also important to remember that what we're investing into right now, it's a bit of a different chapter, I'll call it. I mean, we're coming off 40 years of deglobalization, and those 40 years led to consistent interest rate declines, right? And so that was downhill skiing, if you will. And downhill skiing is a certain sport, right? It's about speed, agility. There's an adrenaline to it. Move quick. Having cash was a scarce resource, right? And being able to move quickly with certainty of close was everything. We're in a new sport now, is my view, and that sport is cross-country skiing, right? So I think that we're going to see, again, more friction cost in the global economy. That is going to mean that the rates are going to be higher. I think growth is going to be a little lower. And so that's cross-country skiing, right? It's a different sport. It can be won, right? But it's going to require endurance. There's a mental mindset that's going to be different. In real estate, it's also going to be much more important to generate alpha. And how do we really work these assets and create cash flow for our investors? And so that, again, it's a different sport. It can be won, but it's different.
The next 3 to 5 years, what excites you the most? What do you see as the real amazing opportunities?
Without question, I think real assets is going to have a very interesting run right now. I think that real assets, more broadly, include infrastructure, include other things in that, represent, I think, a very interesting opportunity set for investors to own real things, right? And you look at what's happening in different sectors and how well allocated most of them are, equities, fixed income. And a lot in real assets, specifically the built environment, is very underallocated as an asset class. And I think that is going to represent a great opportunity for investors to be able to buy something today, have it cash flow, and given what I think will be an era of a bit higher inflation than we're used to, a bit higher rates than we're used to, and certainly a lack of new supply that we're seeing right now, they won't regret it. It's going to be an asset that will appreciate over time.
Great. Well, David, thanks for joining me today.
Thank you.